In today's video, I'm talking about the future of mortgage interest rates, and it may not be good news for those of you waiting on the sidelines. So let's get started. Hey, for those of you that don't know me, I'm Rick Harrison with MVP Realty here in Southwest Florida. And on this channel, I bring you the latest insights and information to help you decide if this is the right time and place to make your move. If that thought's crossed your mind, you're in the right place. So subscribe and tap the bell to stay up to date on the latest information, keeping you ahead of the curve. And for those of you that are thinking of making a move in the next 6 to 12 months, you might want to check out the video for my Home Hunter program with the link in the description. All right, now let's dive in. All right, so in this first article, we're looking at John Burns Research. Real Estate Research is one of the top research firms in the country for real estate specifically. And their article is titled, "Will the Strongest Housing Demand Surge in 20 Years Continue?" I've already gone ahead and read this article and highlighted most of the important highlights that we're going to be looking at today. So the first one is, while the number of adults in America grew at the lowest rate in decades from 2020 to 2022, household formations actually surged. So that's actually the opposite of what was expected, and that surged to 1.5 million per year. So John Burns Research attributes the changes in living patterns and the unexpected housing demand surge to the new ability of millions of workers to work from home. So that's something we've been talking about quite a bit on this channel for over a year now. Remote workers needed more space, more privacy, and fewer roommates. So without a daily commute, remote work allowed workers and families to move to lower cost areas. One of the examples we used was New York City. Obviously, the cost of living in New York City is extremely high. So with more people being able to work from home, a lot of those city dwellers decided to move out to the suburbs. Also, people moved all the way to Connecticut because they could work from home. So much lower cost of living there compared to the city. And it's really still not that far away if they did need to commute. That's really kind of the trend that we've been seeing in a lot of major cities around the country. So what's in store for housing demand? Well, millennials and boomers will continue to drive home purchases growth by 35 to 49-year-olds, and 65-plus-year-olds will continue to move to a retirement home or age in place and remodel. So we're seeing a lot of that happen down here, especially in Southwest Florida. The aging in place. A lot of people have really low rates, below 6% on their mortgages for their condos and their homes. So they don't need to really sell. If they wanted to buy, that's great. But if they don't need to, then they don't have to, and they're probably not going to, which is what we're seeing right now. And that's contributing and leading to a lot less inventory. So their big takeaway here is to expect solid demographic housing demand through at least 2030. With that, permanent work from home is boosted, even though a lot of people have been, a lot of CEOs have been calling for people to come back to work. That's not being required yet, and there's a lot of pushback. So I don't really see that going back, and a lot of people don't see that going back to how it was beforehand. More homes are needed. We all know that. Rebounding adult population growth will fuel new household formations and new housing demand through the rest of the decade. So we're looking at a decade-long process here. Suburbs and exurbs will grow the fastest, plus 7.3 million additional 30 to 49-year-olds between 2020 and 2030 will push demand for housing into the suburbs due to people moving from more expensive urban areas and needing more space. All right, this comes from Bigger Pockets. I've mentioned them a few times. They're one of the largest real estate investor sites and just brands in general. This article is "Buckle Up Investors, Interest Rates Are Only Going to Get Worse From Here." Now, even though this is directed more towards investors, the same thing is going to be true for any regular buyer who's got to be financed. Some of the highlights here: inflation is more than double the Fed's target rate right now. Even though we just came down and CPI has been decreasing, we're still at 4.9%. Actually, we're down to 4%, which is still double what their target rate is, up 2%, right? So, and the unemployment rate is the other big thing, which is way below the FOMC's participants' estimate of the natural rate. We've had a really nice decade, lots of job opportunities and lots of job growth. Job openings, a lot of people have been employed. This brought unemployment way down. And then we also had really low interest rates for a long time, which was great. But that whole environment has changed. So there are a lot of reasons to think the Fed will begin reversing course on rates. If not at the end of 2023, then probably in 2024. Now, when that happens, if you look historically, that's usually when the recession is really noticeable, and that's when it really kicks in. But with that, in the short term, things look good for interest rates. So I've been talking about that a lot lately. I think interest rates are going to come back down, and we're going to actually take a real brief look at interest rates right now, just so I can refer to what I'm talking about. All right, so this is the U.S. government 10-year yield. So I talk about a lot on this channel, the 10-year yield, because the 10-year yield is really what dictates where mortgage interest rates are going next. It's kind of the lead indicator, and there's usually a spread of about 2%, somewhere around 2%. But lately, it's been a 3% spread. So wherever the rates are, if you take a look over here on the right, we're at 3.8% right now for the 10-year yield. So add another 2% to that normally, which would put us up to around 5.8% interest rates. That's in a normal environment. But because there's so much risk in the market right now with banks, with all the bank crisis, everything that's going on in the economy, they've actually added in an additional 1% for the risk. So instead of it being 5.8%, we're now looking at around 6.8% as of today. But what I want to bring your attention to here is the broader perspective on this. This goes all the way back to 1913. This is the government 10-year yield from 1913 up to today. As you can see, and this is true for just about everything in life, there is a cycle involved with this. So you can see back here, we were at almost, 6%. And if you did the average interest rate over time is about 6%. But obviously here we were at an all-time high back then. Then it came all the way down here and it went down to almost 2%, which puts interest rates around 4% back then. But then we went into our upcycle, our inflation rates, and that went all the way into the 70s and into the early 80s. And that's when we started to decrease rates again when inflation was super high. That started to come back down. But the point of this is that everything is a cycle in the economy, in life, in nature, in relationships. They're all cycles. So we had a cycle where there was a high inflation cycle, and then we went down to all-time lows, and we got almost to 0% interest rates, which is extremely low and artificially low, really. But now we're making our way back up. Now, this is just my opinion on this, and I think it's history has kind of shown that over the years. But I think we're going to be entering, as that article said, a decade long where we're looking at interest rates increasing. The best example I can give to you is look at gas prices over the years, right? I remember when I was, it had to be when I was still in high school, gas was still around $1.50 per gallon, or maybe it was up around $2. But I do remember, going in towards the financial crisis of 2008, prices went up to around $3.50 or so. And people were really upset about it. But what happened after that? They lowered the prices of gas down to $2.50, $2.75. So it was still higher than it was before. But because it had gotten so high that people were upset, they lowered a little bit. People were happy. And that's the same thing that they do with rate hikes too. You raise the rates up to a point where people are uncomfortable, then you lower it a little bit. It's still higher than it was, but people are happy with it. Then you raise it again, and then you lower it a little bit. So I think we're going to be entering a decade where we're going to see that cycle go the other way, where we're going to be raising interest rates, which for those of you who are on the sidelines, buyers, this is not a guarantee. This is not, nothing's for sure, but this is just my educated guess here. I think we're going to be seeing interest rates continuing to rise. And I think 5 to 6% is going to be the norm now for quite a while. All right, before we get into the local market stats, I do just want to touch base on the wall of worry, since I haven't done that in a while. But some of the things that we need to be taking a look at right now. One, just in general, the cycle itself. So right there in the middle, everything is in a cycle. As I just showed you with the 10-year yield, I think we're going to be in an upswing cycle, a bull cycle for interest rates, mortgage interest rates, and then also for bonds, just because they seem to be a safer bet right now. And we have a lot of stuff changing in the market. Top left, banking crisis. There's still some issues going on right now with the banking crisis, and it looks like there may be a second wave of defaults in banks coming. There's a couple articles out there floating around right now that is something that people are looking at. We've talked about commercial real estate in the past. We're on the top right. That's going to be a big issue coming up, that all of those things really come due within the next year. We're going to be seeing a lot of that hit the market fairly soon. The Fed pivot, as I mentioned earlier, to the bottom left, stock market. Obviously entering a recession, stock markets can take a hit, and that can also affect people's portfolios to the point where they want to sell maybe some extra real estate or some vacation homes that they don't necessarily need anymore. And then another big one that's coming up pretty soon is the student loans. That's going to be taking effect, and that could be a fairly large expense for a lot of homeowners who may have just gotten their first home over the last few years when they didn't have to pay that. That could be a huge bill that they weren't expecting or are unable to pay. All right, let's get right into the interest rates. So as of today, the interest rates were at 6.69%, probably going to be going up a little bit with the way that the bond market has been acting all morning. And that was up just a little bit from 6.5%, but about 2 weeks ago, we were at 7%. So that's actually down quite a bit. Bank rate actually still has us at 7%. So that's up 6 basis points. All right, Cape Coral to Naples. The last time we did this and we looked at these, which was about 3 weeks ago, new listings were at 889 and new listings are at 805 this week. That's down 10%. But that is actually up quite a bit because we were only at 600 or so units a week and a half to 2 weeks ago. I have actually done these reports and I had them all videotaped out over the last couple of weeks. I just never got to post them. Solds went from 750 to 692. That's down 12%. Pendings went from 905 to 825. So that's down 9%. And then price decreases pretty much right in line with the amount of new listings coming on. That's down 22% though, but the price decreases are at 814. Single family, last time we did this, they were at 6,002. We did have a huge gain of 120 this week for single families. For condos, we had a gain of 96. So last time we had a net gain of 81. This time we have a net gain of 216, which is a pretty large increase in inventory in the southern part of Southwest Florida. That's a little bit different for the northern part though. Multifamily is not much of a change here. We gained a couple. Foreclosures, we lost a few. And then for total sales, we had 549 over the last 7 days. Out of that, 50% of them were cash deals. Northern part of Southwest Florida, Punta Gorda, the Sarasota, 610 new listings last time. New listings are at 617, which is a 1% gain. Solds went from 627 to 641, so a 2% gain there. Pendings down 9% to 663. And then price decrease is pretty much no change. It was literally a change of 1. And then as far as the inventory, we gained 155 single family homes in the northern part. We lost 53 condos. So we had a net loss of 17 last time. We have a net gain of 102. Pretty good swing, but nothing real crazy. Multifamilies gained 4 there as well. Foreclosures gained 3. And then we had 567 total sales over the last 7 days. And 53% of those were cash sales, which was an increase of about 5 or 6% from the previous recording. I just want to break down the northern part, the statistics, some of the interesting things that have happened month over month. Active listings were up 65% from last year. So that's a huge increase, obviously, but it's down 4% from last month. Other than that, pretty much everything else is down. New listings were all down, both month over month and year over year. Pending sales were down, listings were down. Listings sold were down. Active days on market is up 188%. It was at 16 days on market a year ago. We're now at 46 days on market on average. And that's actually down a little bit from 50 last month, which means that some more buyers are entering the market right now. And then the other one is average sales price. So that is up 3% from last month. So like I've been saying, it has been steadily increasing about a 2 or 3% clip every single month, which means prices are still going up. And then over from last year, it's up 2%. As always, we've got a lot to keep an eye on, and that's exactly what I do on this channel every week. So don't forget to subscribe. And if you're planning to make a move to Southwest Florida in the near future and are just waiting for the market shift, you can start preparing by learning more about some of the unique programs and services I offer, which you can learn about more in the video that pops up at the end or the link in the description. And if you have questions, feel free to call, text, or email me anytime with my contact link in the description as well. Thanks again for watching. I hope to see you in the next video. But until then, stay safe, stay positive, and more importantly, stay free.